Okay, so we're in Rapperswil, and this is the castle. So Rapperswil is famous for its castle. It's got a beautiful castle, and I really recommend coming to visit this place if you have a chance. Going to take a look, going to explore. Let's go and find out, huh? So Paul's walked ahead of me. I'm just trying to catch up with him. There he is. There he is. Where were you?
I was just hiding, James.
So I'm here today with Paul, and he's going to talk about a topic that he's very passionate about. A little bit different from what we talked about last time. Last time we spoke, it was about the Jenga economy,
That's right.
which was absolutely fascinating. I really enjoyed, the last time we met. Today, though, is about growth and value, or value and growth.
Absolutely.
And we're going to talk about something that's been covered quite a bit recently, that's caused a lot of confusion, and hopefully we can clear some things up.
Absolutely. So the first thing that I would like to say, James, is that obviously a stock market index at any given time is a composite of stocks that are expensive and some stocks are cheap, and that's what gives you the overall index level. And basically, when we talk about style investing, there are two elements to that. They're called growth and value.
That's it.
Absolutely. And growth is like the area that has been performing strongly for the last 10 years. If we think in terms of the S&P 500 index, for example, we know that over the last 10 years it's actually moved into the stratosphere. But it might surprise you to know, James, that, well, firstly, this isn't a trick question, but how many stocks do you think there are in the S&P 500 index?
Oh gosh, that's a tough one. 500?
500 is the correct answer. But if I were to tell you that only 10 stocks out of those 500 account for 25% of the growth we've seen over the last 10 years, it gives you an idea that there's a bit of a distortion going on somewhere underneath.
Yeah.
Yeah. And I think, when we look back to the late 1990s, we talk about the technology boom, and those closer to investment circles would talk about TMT, which is technology, media and telecommunications, which isn't easy for me to say. And it's very, very difficult to make an absolute comparison, because when we think about media and how that's changed in the last 20 years, 20 years ago we were talking about print advertising, we were talking about radio and TV advertising revenues, and now we're all playing around with our handheld devices and laptops, and Google's following us everywhere we're going.
Yeah,
and
changed completely.
Yeah, changed completely.
Age.
This is the digital age. But if you look at the composition of the S&P 500 index over the last 10 years, the technology weighting has gone up from around 15% to 21.5%, and in the first half of this year alone it went up 1.3%. One of the big misnomers that we ought to cover is that a lot of investors would intuitively think that you invest in growth stocks when the economy is growing.
Yes, I mean, it makes sense, right? Yes, I mean, it makes sense to the average person.
Absolutely.
The economy is growing, buy growth stocks.
Yeah. But
why is that wrong?
Why is that wrong? Because the sort of reason for buying growth stocks, if you're a growth investor, you are looking at stocks that will keep growing whatever happens to the economy. And so, for example, I mean, it's a logical argument to make now that, bearing in mind I've got a new smartphone.
Oh yeah, he's got an iPhone 6. It's new for Paul.
But I think it's safe to say that we're all going to be buying new technology.
Yes.
And whatever happens to the economy, okay, if we're jobless and destitute, we're probably not investing in mobile phones. But if we maintain, our working existence, we've got a salary coming in. The chances are, even if we go into a recession, we're not going to say, I can't upgrade to, in my case, an iPhone 7 because we're in recession.
Don't buy the iPhone 7.
Don't buy the iPhone 7. So that is the point. They're better able to weather the conditions. And conversely, when the economy is growing well, you're actually thinking of value stocks because value stocks offer a value proposition. They have steadily growing dividends. They're normally very solid companies, and it's more intuitive for us to be able to value them. If you think of a wholesaler, it's got warehouses.
Yeah, they're tangible.
Yeah, it's tangible.
So you kind of know how
exactly.
much they should really be worth.
It's not uncommon for a value stock to trade below its book value, which would actually imply that the company is worth more if you break it up than it is as an ongoing business. And this happens. That's where the distortions come in. And so when we talk about just how far technology stocks have come in the last 10 years, then we've got to be thinking that value stocks are undervalued. And this type of dynamic has been monitored. There is data going right back to 1936. And this has actually been the worst period, the last 10 years, the worst period for value stocks since those records began.
Brilliant. Let's get a chart up there to show that.
Yeah, absolutely.
Yep.
Absolutely. So if you're asking yourself, is the stock market expensive? Well, we discussed that when we did the Jenga economy. There are many ways, different ways of valuing a stock market. And if you look at, interest rates, etc., like we did last time, it doesn't look that expensive.
I mean, collectively, where markets are a reflection of where interest rates are.
Yeah, exactly. I mean, it's a topic for another day if we want to talk about how to value a stock, but the value of a stock should be the discounted value of its future earnings streams. So basically, at certain points, the market will put a premium on that earnings stream, and at certain points, they'll put a discount on it. Just for the people watching, Hans Uli runs a fund called Euroland Value, and he's at Divas Asset Management.
Yeah, we're both a very good. We're both big fans of Hans Uli, actually.
We are.
He's a tremendous track record behind him. He's one of the best kind of Euro value.
And he's one of the guys that really sticks to his guns. Exactly. If the market isn't working in accordance with his strategy, he's just going to stick to it. And basically, he's got a tremendous record in outperforming even when the market doesn't suit his style. So we should have him on another occasion.
We should do. And by the way, this is not a promotion. We both have met him at different points in our own career and worked with Hans Uli. So I'm just going to put if you want to check out his new fund, I'm just going to put the link there. And this is not a paid endorsement.
No, actually...
Although we should actually charge for this, shouldn't we?
Actually, Hans Uli is legendary for not giving
he doesn't even know that we're doing
absolutely.
Mentioning his name.
Absolutely. Absolutely. So anyway, let's talk about another great investor, and I'm sure Hans Uli would be delighted to be mentioned in the same breath as Sir John Templeton. Sir John said, his most famous saying was, the four most expensive words in investing are, this time it's different. And of course, if you apply that to growth stocks and the way that they've exploded in terms of pricing over the last 10 years, what Sir John would be saying to you is, don't believe this is going to go on forever, because this time it's not different. And this time, James, it really isn't. When we look at value stocks, we can look at the company and we can understand the way that companies do business.
Yes.